This is an important step because mid last week, the Warner Brothers board recommended shareholders reject the tender offer by Paramount for $30 a share, and they listed a list of reasons why. And one of them was that there was no personal guarantee from Larry Ellison, and now the company Paramount has addressed that this morning with a number of amendments to their tender offer.
But that means he's putting his equities up at stake, right?
Yes,
as collateral.
and they confirmed that they hold 1.16 billion Oracle shares. And if you look at, an Oracle share is about $194 or so. That's about $225 billion. So that is obviously a large amount of value there. And the fact that he's personally backing it is something that Warner Brothers was looking for.
Still, a pro forma Paramount Warner Brothers, it's going to be highly levered, isn't it? Talk to us about the debt profile there, and how do you view it?
Yeah, so it gets very complicated. So a pro forma, Paramount Warner Brothers will be highly leveraged. You're talking, mid 4 times leverage overall, and that's accounting for a significant number of synergies that we're giving them credit for. So if you look at expected EBITDA for Paramount, expected EBITDA for Warner Brothers, and then you add on top of that what they're targeting is $6 billion of the annual run rate cost savings. It'll take them a few years to get there, but if you say pro forma, we'll give them credit. The company's still highly leveraged at about mid 4 times.
And X that, it's above 5 times.
Oh, clearly, yes.
Yeah, come on.
Yeah, and
you're a credit guy. You're not giving them credit for the synergies, are you?
Well, you have to give them some credit, but you really want to see it done.
I mean, as an equity guy, I'm all in on the synergies.
We usually are a little bit more negative. Well, what's important too is how they break it up. So part of the commitment they have on the creditor side, right? So you talked about Larry Ellison and some other equity providers providing over $40 billion of equity capital. They also have a $54 billion secured bridge commitment. And now that's secured. So if we assume that debt is ahead of all the existing debt that's at both Warner Brothers and Paramount Skydance, and again, you give them credit for synergies, you're talking about pro forma leverage through the secured debt of about 3 times. Now, there's a possibility that you could get that investment grade rated using Charter as a comparable. So if we look at Charter, which is one of the biggest cable companies out there, they owe almost $100 billion. Of that, about $70 billion or so of it is secured bonds and loans that are IG rated, and they're about 3 times levered. So if we use that at a comp, maybe you could get to investment grade ratings from at least 2 of the 3 agencies to qualify for investment grade for that $54 billion, which would be very key to financing.
All right, I know we're talking about Paramount, Skydance, and Warner Brothers as the principal players here, and Netflix, if you want to get into that side of the bid too. But I'm curious, and this might be a dumb question, Larry Ellison now personally guaranteeing the equity financing. There's a lot of questions about Oracle and its debt overall. We've seen the credit default swaps on its debt rise. That's the cost to insure against a possible default. Does the fact that Larry Ellison is committing to backing a large portion of the money needed for the deal, does that affect Oracle's credit rating at all? Would a credit investor and analyst look at that and think, No,
well, don't forget, Oracle still has a massive equity market cap, right? And the stock is traded every day. So the market is telling you every day what they think the value of Oracle equity is worth, right? And he has, again, the $1.16 billion, 1.16 billion of shares worth about $225 billion. And that's what the market's saying it's worth. So that's what a credit investor would look for, that comfort, or a equity investor at Warner Brothers Discovery saying that is backing up his $40.4 billion.
And a credit investor wouldn't worry about that part of it.
I don't think indirectly you could have some concern about it, but I don't think directly you would.
The average credit investors that you talk to at Warner Brothers, which deal do they prefer?
Well, it's complicated. You would argue that it's interesting. Is the Warner Brothers bonds were investment grade rated, right, through through half of last year, or half of this year, 2025, and then they were by far the worst performing, huge negative total return. They went into junk. They were fallen angel in July, and now they've bounced back in one of the better performing high yield names because of all this speculation of some sort of takeout. In either case, the bonds are probably better off than they would be without it, but there's still some concern. So if they go with the Paramount Skydance deal, there's a chance they could be behind all that secured debt that we talked about, that $54 billion of secured debt. But you have all that equity capital coming in that's supporting the overall company, which would give you support as a bondholder for Warner Brothers. Now, the problem with the Netflix deal is that if you're a bondholder, you're probably left with the global networks, which is going to be spun out before Netflix comes in and buys the studios and streaming operations. And that company will be relatively highly levered with a declining business. So I'd say it's pretty close, but maybe you'd lean a little bit towards Paramount Skydance.
Really?